If you're in your 20s and you're not invested in the stock market right now, every single day you wait is costing you money. Real money. Life-changing money. Here's what nobody told you when you were growing up. Time in the market is worth more than any stock pick. But the stocks you pick? They can change everything. Today I'm breaking down exactly what a 20-something should own right now. From the no-brainer foundation that Warren Buffett himself endorses, to the high-conviction growth plays that could 10x your portfolio over the next decade. This is the Money Profits. Let's build something. Quick note before we dive in. This is not financial advice. Do your own research, talk to a professional, and never invest money you can't afford to leave alone. This does not constitute financial advice. Always do your own research before investing. Now, let's talk about why your 20s are the single most powerful investing window of your entire life. Here's a number that should stop you cold. $500 a month invested, starting at age 25, at a 10% average. Annual return grows to over $3.2 million by age 65. Wait until 35 to start. That same $500 a month gets you roughly $1.1 million. Same monthly investment, same rate of return. A 10-year delay cost you over $2 million. That's the power of compounding. And in your 20s, you have more of it than you'll ever have again. So the question isn't whether to invest, the question is what to own. Here's the playbook, broken into 3 tiers. Tier 1. The foundation of your entire portfolio. VOO, the Vanguard S&P 500 ETF. Before you roll your eyes and say, that's boring, hear this. Warren Buffett, the greatest investor in history, has publicly stated that when he dies, 90% of his wife's inheritance should go into a low-cost S&P 500 index fund. The man worth over $100 billion isn't telling his family to pick stocks. He's telling them to buy the index. And here's why this matters for you. VOO tracks the S&P 500. 500 of the largest companies in America. Apple, Microsoft, Nvidia, Amazon, Google. They're all in here. One ticker, instant diversification, and an expense ratio of just 0.03%, meaning for every $10,000 you invest, you pay $3 per year in fees. The 30-year compound annual return on the S&P 500 sits at over 10% per year. The 10-year annualized return on VOO through mid-2026 is 15.68%, and the single most important stat, even at the worst possible entry point. In VOO's entire history, the worst 10-year rolling return was still over 11% per year. This is your base, your foundation. Whatever else you invest in, this comes first. Target allocation for your 20s. 50-60% of your portfolio. Tier 2. This is where you get aggressive, because your 20s are the time to take calculated risks. These are individual companies, with long runways ahead of them, businesses that aren't just doing well today, but are positioned to dominate the next decade. You cannot talk about the future of technology without talking about NVIDIA. This company makes the GPUs, the graphics processing units, that power artificial intelligence. And right now, AI is not a trend. It's infrastructure. It's the electricity of the modern economy. NVIDIA's revenue grew 62% year over year in its most recent quarter. Their data center revenue hit record highs. And the company is about to release its next-generation Rubin AI platform. The question investors debate isn't whether AI will grow, it's who captures that growth. And right now, NVIDIA is the toll booth on the AI highway. Volatile? Yes. But if you're 25 with a 30-year time horizon, volatility isn't your enemy. It's your opportunity. Alphabet, Google's parent company, was the best-performing stock in the Magnificent Seven in 2025, gaining over 60% in a single year, and it's still arguably undervalued. Think about what this company actually is. It owns the world's largest search engine, the world's largest video platform, YouTube, one of the fastest-growing cloud businesses on the planet, an autonomous vehicle division in Waymo that's quietly building the future of transportation. And it just paid its first-ever dividend. JP Morgan named it one of their top picks. Analysts give it a strong buy consensus. And it's doing it all while aggressively winning back market share in AI. This is a company you hold for 20 years and let do its thing. Microsoft is what you'd call an inevitable company. They own the operating system most of the world runs on. They own the productivity suite most businesses run on. They have a 27% stake in OpenAI, the company behind ChatGPT. And their Azure cloud business just grew 40% year over year. Revenue climbed 18% year over year to $83 billion in its most recent quarter. Earnings per share came in at $4.27, above what analysts projected. Microsoft slightly underperformed some of its tech peers in 2025, which means it enters 2026 looking like one of the more attractive entry points of the last several years. If you want AI exposure, enterprise dominance, and a company that literally cannot be disrupted overnight, Microsoft is it. Most people think of Amazon as a shopping website. What it actually is one of the most powerful cloud computing businesses on the planet, combined with one of the fastest-growing advertising businesses in the world. Wrapped inside a logistics empire, AWS, Amazon Web Services, is the profit engine. Its North American e-commerce segment saw operating income surge 28%, even as revenue grew at a more modest 11%. And their robotics and AI investments are creating massive operating leverage. Amazon also signed a $38 billion cloud deal with OpenAI, positioning itself as a critical AI infrastructure provider for years to come. For a 20-something, this is a company that still has multiple decades of compounding in front of it. Target allocation for Tier 2, 20-30% of your portfolio, split across 2 to 4 of these picks. Tier 3. This is the spicy section. Your 20s are the one time in your life where a calculated high-risk bet makes mathematical sense, because if it goes to zero, you have 40 years to recover. And if it works, it changes your life. This isn't gambling. It's asymmetric risk management, one category worth watching in 2026. AI infrastructure enablers. Companies building the picks and shovels of the AI gold rush, semiconductors, data center REITs, energy infrastructure powering AI compute, are in the early innings of what could be a multi-decade build-out. This is where doing your own research matters most. The companies in this tier vary widely in risk profile, but allocating 5-10% of your portfolio to high-conviction emerging plays is exactly what your time horizon allows you to do. Target allocation for Tier 3, 5-10% maximum. Don't overweight what you can't afford to lose. So let's bring this together. Here's a portfolio framework for a 20-something starting to build real wealth, 50 to 60%. Foundation, VOO, or another S&P 500 index fund. Set it. Automate it. Don't touch it. Twintast, 30%. Growth engine, 2 to 4 individual stocks with long runways. NVDA, Google, MSFT, AMZN. Pick the ones you believe in and understand. 10%. High conviction bet. One emerging play in a sector you've researched deeply. This is your swing. 10%. Cash or bonds. Always keep some dry powder. Markets go on sale. When they do, you want to be ready to buy. This isn't a get-rich-quick scheme. And this is a get-rich-for-sure scheme if you stay consistent and stay patient. Here's the final thing I'll leave you with. The biggest risk in your 20s isn't picking the wrong stock. It's waiting. Every month you sit on the sideline is a month of compound interest you never get back. The market will go up. The market will go down. But over 20, 30, 40 years, history says one thing with remarkable consistency. The patient investor wins. Start with VOO if you don't know where to begin. Add individual positions as you learn. Keep your time horizon long and your emotions short. Your future self, sitting on a portfolio that did what your 20s allowed it to do, will thank you. This is the Money Profits. If this hit different, subscribe, because we're just getting started. Drop a comment below. What's the first stock you ever bought? Let's talk about it. We'll see you in the next one.